let's say like a 5-year note was issued newly 5 years ago. Well, now it's coming due, okay, this week or this month. And so it gets refunded. So we just keep it going as opposed to like ending it because we need the money, right? So we don't have the money to pay it off because we're a debtor nation.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
It's KP coming to you live from PRG President's Cabinet. Let's go. The Uncle Show. Cheers, y'all. These are all your winners of 2024. We just ended our farewell dinner. Cheers. Cheers. Hey. Best damn team and the best damn President's Cabinet award trip that any lender did in this business. Sorry. You know I don't like promoting my company, but I got a little fired up. We've been here for a week on a cruise after the worst year of the market. You know why? Because the market. We show that market that they're not going to throw anything at us like they did in 2023, and we're not going to come back firing. So, okay, that's it. No more PRMG stuff. Let's talk PCE, personal consumption expenditure. What came out today, inflation. We have a humongous week next week. It's earnings week this week, huge earnings week next week. We have a jobs report. Let me give you some entertainment here so don't piss this guy off. Watch this. We're in the Eden bar. We're in the back of the boat. We got a guy singing here. He's literally about to sing. Cheers. There we go. So huge week next week. Jobs report coming out on Friday. Payroll, the BLS jobs report. The PCE came out today. We had a GDP number with inflation numbers in it that came out yesterday. And we also had, sales reports and whatnot. Next week is the Fed meeting, May 1st. And, of course, the beginning of the week, we have the Treasury refunding amount. So it's like basically announce how many treasuries have to be sold. So I want to talk about how all those things come together. And I'll throw in a couple nuggets that maybe you haven't heard. But let's talk about the PCE first, the personal consumption expenditure. It is the Fed's preferred gauge of inflation. They literally call it the Fed deflator, the PCE. Why is it their preferred measure? Well, it gauges inflation, and it talks about the expenditures that consumers make on a monthly level. Now, it's the March PCE. By the way, this room is weird. Let me check this out. The scenery on this boat's cool. It's the latest report in the month of April for data in March, and it was today, and it was as expected. So kind of like the Tesla earnings I brought up in my last report is not as bad as feared, right? So when something is not as bad as you thought it was going to be, get you some ocean. Get you some ocean out here. You guys are going to dig this. These are life boats, by the way. Hopefully I don't need one of those. None of us need one of those. Or I'll be that lady telling that story. It's been 84 years. Or 82 or whatever she says. No Titanic references, please. All right. So when you're talking about not as bad as feared, we know January, February, March inflation was tough, including the PCE. And so we had a GDP PCE component in it that just came out yesterday and or this week, and it was not good. It was high, but that is an annualized number. They take a quarter and they multiply it by 4, which gives you like a 3.8% or 4% number, whatever it is they said inflation was, which we know that's not what inflation is. The reading today is a monthly reading. So March of 23 gets removed and March of 24 gets added in. And when that happens, you have 2.8% annualized inflation. We had 0.3% inflation. Look at this little room. It's like a little river here, just discovered. But speaking of whatnot, I might sit in there. Hopefully the wind's not too bad. So 0.3% inflation. If it would have been 0.4, markets probably would have sold off. Rates would have gotten worse. 10-year would have gone above 4.7. It didn't. In fact, stock market rallied. Bonds rallied, got better. 10-year, improved down from its peak this week. And so why is that? Like, inflation didn't get better, did it? It was not a good read at 0.3 on the PCE. 2.8% is not good, but it's not as bad as feared. And so we've kind of bracketed this little level. I don't know that we'll see 5% on a 10-year Treasury. We're at 4.7 max this week, or 4.71. That's about 30 basis points or 28 basis points off the peak when we saw 8% average interest rates. Well, we don't have those interest rates right now. We're in the mid 7%, right? Because the 10-year, 30-year fixed mortgage spread has gotten more narrow because institutional money is getting used to this range. Yes, it was volatile the last 45 days. The 10-year Treasury went up because inflation readings went up, but we're kind of used to that. So what blew a hole in the inflation theory this week? I wouldn't say blew a hole, but GDP coming out at only 1.59%, 1.6% GDP for Q1. That's slower growth. And that's way less than the 2.5% that was expected. Now, not to get too technical, but a lot of that had to do with us having more imports and less exports. And why is that? Well, companies are starting to build inventories because we were big exporters in Q3 and Q4. And also because the dollar is very strong. Did you know the dollar is the strongest against the Japanese yen? But like the Japanese yen is literally the lowest level it's been in 34 years. Sunset. Got you a sunset back here. You see that? We are over the Atlantic Ocean. Would not be good if I fell over here. I think I would make it. Anyway, so the Japanese yen is the lowest it's been against the dollar. That's a problem. People don't want to buy our goods overseas where we make more on exports and have a higher GDP when our dollar is so much stronger. Foreign currency does not go very far against a strong dollar. And that is not a conspiracy theory, but is a reason that motivates the Fed to potentially cut rates. Don't know when, don't know how. Japanese is our largest foreign buyer. It's no longer China, it's Japan. They're our largest foreign buyer, and they are an ally. They are an absolute ally of the U.S. So, they held their rate steady with the Bank of Japan, and then the yen value fell against the dollar. Why is that important? We buy and sell money. We've been selling treasuries at an extremely high level. Did you know we had a 2, 5, and 7-year note auction this week? And they were like the biggest amounts ever sold. I think one of the auctions was $70 billion in one auction. Okay? And there's auctions for treasuries like 3 every other week or 3 a week. I mean, it's crazy. So next week, when the Secretary of Treasury, Janet Yellen, who's a former Fed chair, she will announce the next quarterly refunding amount. So that's a big deal. The Treasury refunding amount. How much more is the market going to have to swallow to pay for fixed income securities such as treasuries? That's a big, big number. And so I think last quarterly announcement was 1.6 trillion. And anything above that will rattle the markets. You'll see rates get worse. You'll see the 10-year Treasury go higher. You'll see the stock market sell up. It is market moving. But there's nothing more market moving than the Fed meeting, which is next Tuesday, Wednesday, so May 1st. We will have some information on whether we're going to have, hawkish or dovish statements. Then the labor report comes out next week. So just massive, massive information next week. We have earnings reports. Google crushed their earnings. Meta, slight miss, probably a buying opportunity. Tesla missed on earnings, but then said they're going to have really cheap cars earlier next year. And they showed screens of their app for fully autonomous driving. Imagine owning a car under $30,000 that you could just let go take people places. Uber drivers, Lyft drivers, you better start looking for another job right now. Start trading, because that's going to get disrupted. Like Elon said, there aren't elevator attendants anymore, right? There are things that are self-service. Microsoft crushed earnings. They are one of the few platforms that's monetizing AI right now. And I can tell you, as I've said before on my videos here, we get a lot out of Copilot, Azure, and all that stuff. So we're seeing it happen in action. Apple next week, Amazon next week, Starbucks, just got a hot tip. That's a good pick, especially in an election year, regardless of who wins. I'm not a financial advisor. I'm not responsible for your losses, only your profits. get you a little sunset back there, my Friday evening video. And we are out. Cheers. Hey, it's KP coming to you live from Corona, California. And I am recording at 1:30 in the morning when I recorded 90 minutes ago. This stupid video wouldn't upload, so I'm not going to let it get to me. So I'm re-recording, and I'm just going to drive home. Lots going on. Quarterly refunding announcement. That was the big deal. That was the Department of Treasury, Secretary Janet Yellen, who is a former the Fed chairwoman. And she has kind of a 3-day announcement where they basically go over this is what the refunding and new Treasury funding amounts will be to fund our government. How many treasuries do we need to sell? You know, we had record auctions of 5-year notes and 2-year notes, $70 billion in these auctions last week. So it was important. They announced that they're going to have $41 billion more new issuance than they thought, than they announced in January. So there's going to be more new issuance going out than there was in January. And then, and by the way, just so you know, like it is like early Tuesday morning, the Fed will start to speak later today. And then on May 1st, Wednesday, they have their press release, that's the presser, the Q&A section, where Jerome Powell will decide how to calm the markets. On that same day, on May 1st at 8:30 Eastern Time, is the final number for the quarterly refunding announcement. So Elliot Eisenberg, the bow tie economist, pretty awesome. He put out something, I believe on April 17th, and he said that pre-COVID, every quarter, if you add up refunding of treasuries, okay, so like, let's say like a 5-year note was issued newly 5 years ago. Well, now it's coming due, okay, this week or this month. And so it gets refunded. So we just keep it going as opposed to like ending it because we need the money, right? So we don't have the money to pay it off because we're a debtor nation. So, pre-COVID, $3 trillion a quarter. Q1 this year, $7.2 trillion American. So that's like 2.4 every month. Now, that is some new issuance and then also refunding old treasuries that are expiring. So we're going to get that final number. Is it another 7.2 trillion quarter or more? We're going to find out. So thank you for being patient and walking with me. I got a few more things to go over. This is our lovely office here. Just a PMG up there, but it's late. I'm the only one here, except for there's a cat that was howling and there's a guy doing burnouts on the roof here earlier, peeling out his car. Okay, so Fed meeting, dovish or hawkish, what are they going to say? Are they going to say, oh, car wash. Are they going to say, yeah, we're going to cut rates? No, we don't think so. But what they could say, another form of quantitative easing, is they could say they are going to let the balance sheet run off at a slower pace. So why is that important? What does that even mean? What am I even talking about? Should I even drive and dare to be brave here? There's about $60 billion a month that the Fed is letting run off their balance sheet. And so those are, let's say like a 30-year long bond, okay, for example. So if that is done and the bondholder's been made whole, they would just let it run off and not rebuy it, right? And so refund it. So right now it's about $60 billion a month in runoff. Now the Fed ran the balance sheet up to $9 trillion during COVID, and then they've come back down to about $7.5 trillion. They've been letting balance sheet run off. They haven't been adding new treasuries since they started the rate hiking cycle. And again, that is a form of illiquidity. And so that is quantitative tightening. Now, if they are going to say on Wednesday the 1st, well, we're going to cut our runoff amount of $60 billion a month in half to $30 billion. This is a topic that the good folks, Barry and Dan over at MBS Highway are talking about. That means if they're cutting that in half, 30 billion of that 60, they would have to be buying new treasuries, providing liquidity to the market. So not letting their balance sheet run off at as high a pace, a slower pace, and injecting liquidity to do that. So that's a big thing that could come out. It's not a rate cut. I predicted a May 1st rate cut a year ago, and I will be wrong. But there could be some form of easing if they reduce the amount of balance sheet runoff. So what else is going on this week? What else is important? Well, it's jobs week. Big jobs report on Friday, the first Friday of the month for the April jobs report. Will be interesting to see what they say. It's like 240,000 jobs to be created. We've got the quit rate, jobs opening, labor turnover report, JOLTS report, ADP payroll. Really big numbers that come out. So how is maximum employment in this country one of the three areas of the Fed's mandate? So the other one, of course, is price stability. So I've got some data on inflation that you may find rather unique that you haven't heard anywhere. The Kansas City Fed, and I'm doing this all from memory because I did this, I've already done it once. So it's like I practiced. I normally don't practice. Anyway, the Kansas City Fed puts out a price number. Let me wipe this off for you. And they put out a price number that is services pricing. And this report for April is an early look at prices, and they're down. So all the gains in prices from March that were sharply up are going down, according to the Kansas City Fed. What other inflation data is out there that's positive? The CEO of Walmart, that's right, the CEO of Walmart came out and tweeted the other day. He said that prices for food, such as produce and meat, are in line with where they were a year ago. Okay, so remember, inflation, now core strips out food and energy, but headline number does include food, and everyone I know has got to eat. And so it's meaningful when the largest seller of groceries in America, Walmart, in case you didn't know that, the CEO comes out and says, hey, prices are coming down. They're back in line where they were a year ago. Those are early signs that inflation is starting to get whipped. And I'll add one more, a third one. Goldman Sachs, usually pretty spot on with a lot of their projections. They're not always right, but they're not better than most economists and people predicting the weather. They think that the PCE over the next remaining 3 quarters will be 2.2% for the rest of the year, and that is meaningful. And so, again, a lot of the inflation components are coming from housing, which the Fed can't build more houses. And I personally think that ship has sailed, and there's no way we're going to see less than, 3% house price appreciation. Auto insurance, Fed can't help there. We've got high financial services costs because the stock market's ripping, which, of course, if they have very hawkish comments on Wednesday, they can crater the stock market, take care of that component for the rest of the year. So, anyway, I think there's a lot of data out this week. Amazon's reporting earnings, Apple's reporting earnings. These are huge things that are coming out. And by the way, in all the indices, like the S&P index, there is a rebalancing of these indices in the quarter here. So the stock price and the percentage of the S&P of Apple and Amazon, it's important. So lots of money sloshing around. Thankfully, the Bank of Japan didn't do any damage. They could be cratering the market and dumping a bunch of treasuries, but they didn't do that. And so lots of data coming out. We'll get back to you this week. Thanks for being patient with me and my driving around video if my stupid video is not working. I do have autopilot, so don't worry about me. Cheers. Hey, it's KP coming to you live from Crypto.com Arena. It's where the Clippers just lost to my Mavericks. Game 5, NBA playoffs. Trying to have fun here. Month end. Back to the grind tomorrow. Fed spoke today. There is no stag and there is no inflation. Pretty interesting comments from Fed Chair Powell. So he got out there and he said, stagflation's not a thing. They feel pretty equipped to handle whatever direction the economy goes.
And I thought the tone that Fed Chair Powell took today was very interesting. They said, hey, we've had 3 months of inflation, and we stalled out on progress of inflation. So a year ago, I thought the pace of inflation would keep going, and it didn't. It stalled out. So, inflation's coming down. It's just a lot slower. So what will the Fed do? Does it matter? Does it matter for housing? Does it matter for rates? Well, what was interesting is, even though they didn't have a rate cut today, and they weren't sure when they would start rate cuts, they did actually create some liquidity moves today. They basically said they're going to go from $60 billion a month in Fed balance sheet runoff to $25 billion. That means they're going to buy treasuries, and that's pretty significant. So, we're going. All right, get in the boot. Cheers. They only knew I was a Mavericks fan. They would have booted me earlier. So Fed Chair Powell is going to pump liquidity and slow down quantitative tightening, QT. That's a big deal. It's a real big deal. It's not a rate cut, but it's a step in that direction. And they have said they were going to go in that direction. Now, what's really interesting about it is, everyone's like, oh, we're not at 2% inflation, so they're not doing anything. They're not cutting. They did something. They are more than having their quantitative tightening balance sheet runoff. So they're going to go from $60 billion a month in quantitative tightening balance sheet runoff to $25 billion. That's a big deal. So that will, look, rates got better today. 10-year Treasury actually got a little bit better today. So what else is going on? ADP job payroll report was like 198,000 instead of 180,000, a little better than expected. But wage growth was 5% year over year. Softest it's been in a while. So some good, some bad. The JOLTS report, what a 1.3 quit ratio. It used to be at 2, right? So for every quitter, there's 2 jobs open. Now for every job quitter, there's 1.3. So there's some more softening there. And the ISM manufacturing data slowed back down again. And I know we had some data yesterday, since my last video, that there was, we had basically ECI, which is like, it's like an employment compensation index. It went up, but a lot of it had to do with labor unions and labor union business. By the way, if you've never been to a game here where the Lakers and Clippers play, this is the jam right here. Now, here, watch this. My God, you never know. So go. What we got here? What we got here? Look how much that. Yeah. Well, the best boy. Ocho, shit. $8 for inflation. $8 hot dog. Yeah, hot dog. Let me up. Can I pause live video? No, I'm gonna save some money and some weight. All right, my nutritionist is out there. Justin, thank you. You saw that. I resisted. Whoa. This is. Anyway, all right. Then to the back to the data. So that 1.2% versus 1% ECI number that went up had a lot to do with labor union data, and so if you take the Elliot Eisenberg, hat tip to Elliot Eisenberg, bow tie economist, the productivity went up. So even though employee wages were going up, but productivity went up. So kind of was a wash effect. And then, holy smokes, how about home price appreciation? You guys see the Case-Shiller index, 6.4% in February. February, not like a busy month, right? Seasonally a slow month. Year over year, 6.4% home price appreciation. The 10 city Case-Shiller index was home prices were up 8%. The 20 city index was like 7.3 or something. It's like huge numbers. So what was interesting is I was watching the Q&A today with Chair Powell, and I was wondering if somebody would question him about like all the different components, and he really didn't get into core and super core and housing, but then he kind of did a little bit. But I mean, I thought he doesn't get into like auto insurance or health care costs, but he did kind of broadly talk about shelter, which was interesting. he basically said he felt that he recognized that new rents are lower, and that would continue. And he recognized that there was a lag effect in rental data from a year ago on these, like, the rent indexes. So he recognized it was coming, and he didn't address shelter as in like what I was just talking about was 6.4, 7.3, 8% home price appreciation in a year. He just basically pointed out that rentals is an offset, which we know. So, and he did acknowledge that the lower end of the economic scale is hurting right now. Man, I want one of those dogs. They smell so freaking good. Anyway, they're bacon wrapped hot dogs with grilled vegetables. Anyway, so it was interesting. He basically was talking about the fact that rent will offset housing, and that was it. So that's his take on it. So we're gonna have to wait for that lag effect to kick in. There is no inflation. We don't have a stagnant economy, and we don't have real inflation. He said, I lived through the last time we actually had stagflation, where we had 10% unemployment, you had high single-digit inflation, and low growth in the economy. And we have none of the three, and he went through it, tore it apart. So I know my last video, I was talking about stagflation. The word stagflation has entered the chat, and he absolutely squashed it. He said they're apolitical, said they're not political at all, and they're taking their sweet-ass times. That's the bottom line. So I'm going to do a 3-video week, so I'll just shut the hell up here. Have a great one. Go Mavs. Mavs fan for life.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.